This is going to be a comprehensive video on what I'm doing in the stock market right now because there's a lot of volatility. And I want to present my research to you. This is going to be a very important video. No webinars, no courses, nothing like that. Let's get right to the point. I respect your time and I want to give you a quick summary up front before I go into the details of my research. So what I'm seeing right now is bearishness from investor sentiment, and a lot of investors are very fearful of the market. For example, I have multiple data points here I found from friends working on the ground on Wall Street, as well as personal investors that I'm helping. They have had the most bearishness I have seen in the past 12 months. Now, this in and of itself is not a bad thing. However, when enough investors become bearish, that is a bad thing for the market short term. I still want to reaffirm that I am bullish on the market in 2025 in the long term, but short term, I'm becoming more cautious. I'm actually shifting my personal plan to becoming a more conservative investor. I still believe in tech companies. You guys know that I have Palantir, Tesla, Nvidia, AMD. I have a whole lot of tech companies, but right now I'm doing my best to hedge my positions by using covered call options. I'll also specifically talk about Palantir in this video because I think it's a good time to de-risk, and it's increasingly looking like a pullback in Palantir may continue. This is because of some troubles with Alex Karp. This is also because of the valuation of Palantir and again, where the investor sentiment is for the stock. And the last thing I want to say is I'm still bullish for 2025, but I'm more cautious because of the housing market, interest rate environment, and where corporate earnings are. Although they have been good, the reaction to those earnings have not been good. Okay, so we'll be talking about that in this video. That's my summary. Let's jump into it. AI has to grow in 2025. The reason for it is investors have a really huge appetite for returns right now. Investors have become used to having multiple back-to-back years of 20% return. This is actually a bad thing because it's like getting a new girlfriend and showing her the luxury lifestyle. Now she expects that, right? So the same thing is with investors. It's all about expectations. How do people feel about a stock and what is the psychology of investing? The psychology of investing is herd behavior. And when you get a huge rise in the stock market multiple years back to back, or even a stock like Palantir, which quickly reached above $100 per share, and I made a lot of money. We made money hand over fist on that stock. As soon as it starts to pull back, you get a lot of fear in the market. And then you have, essentially it's like one sheep runs and then another sheep runs after. And then it's like a whole flock of, the whole herd is going in one direction. That's kind of what I see going on right now. And I think that AI has to have the most phenomenal earnings ever in 2025 to meet the demand. Good news is I actually think we will see that. But the bad news is a lot of the market is already priced in, and that's how stock market investing works. The market is an expectations game. Investors have demands. Give what investors want, when they want it, and how they want it, or else they're out. They're not going to hold a certain stock and they're going to sell off and look for better opportunities. I'm going to be presenting some interesting research because for me, it's all about brand. Brands with durability perform in times of good and bad time. My biggest position is actually Apple. And all my Discord members know that Apple actually comes before all the AI stocks. Although I believe in the AI revolution, Apple is my biggest position because of brand. I also have several other stocks. I've had Walmart for a very long time. As long as you have good companies, you can ride out the turbulence. And I want to show you guys a quick clip of a marketing strategist, Julie Beal, as she had the smartest advice I've literally seen, better than Tom Lee, better than Dan Ive. What she said was absolutely genius. The clip is 2 minutes, but it will show you how to navigate a turbulent market, and then I'm going to tell you what she said and what that means for your portfolio and how we can implement a plan in your portfolio to navigate this current market. So let's watch this clip.
She's got the names that can ride out this wave of uncertainty. Julie Beal is Chief Market Strategist and Portfolio Manager at Kane Anderson Rednick and a CNBC contributor. How frustrating is a day like this, Julie, and a week like this? Welcome.
Thank you. Yeah, no, I think this is actually one of those markets where you really have to have a lot of conviction, and that is what allows you to stay zen. That's the real key is you don't want to just be doing things for the sake of doing things. It's the opposite of the old adage. Don't just do something, sit there. As long as you have good quality companies, you should be able to ride out this turbulence.
That's another kind of a deep allusion there to Buffett and Munger, who famously said, inaction is the hardest thing. You're trying to emulate them in other ways too. Tori, what was our mystery chart? Julie, what was our some of your stock picks? Okay. That's not one. Advanced drainage, Julie, is what we were teasing today. I don't think anyone would have guessed that. Why is it on your radar?
Yeah, I think there's so much excitement and hype around AI. And I think I really do think that is going to be very transformational technology, but I also think it's going to be really flattening technology in terms of suddenly it's going to be really table stakes to have a high level of information access, analysis, optimization. And for me, I'm really much more excited about companies that are grounded in the physical real world, right? AI isn't going to fix clean water the way that advanced drainage and their pipe solutions are. So I think companies that are really grounded in the world that we have are actually more compelling to me because they're better able to differentiate themselves. Simpson is another great example. That's a company that, has 70% market share in the kind of sure tie, strong tie for structures for home building, or something like a West Pharmaceutical, which manages the injectable drugs. It's the drug delivery systems. We know that there's going to be more injectable drugs. AI isn't going to really touch that, and so it's these kind of real-world companies that I'm really attracted to right now.
Yeah, all of that said, do you look at the broader economy right now, some of the data points lately on the consumer, and none of these stocks are really consumer plays, but there has been a bit of a weakening.
Absolutely. And I think that it's really important for us to bear in mind that while we look at all of the data around infrastructure spend, manufacturing, all of that, what's so critical is to recognize that we thought there was going to be a recession in 2023. We think that there are so many challenges facing this market. And the fact of the matter is, it's the jobs market, stupid, right? The strength of the jobs have really been what has propelled this economy. And it makes sense. This is a consumer-driven economy. The more that we can recognize that the health of the jobs market is what really is going to determine our fortune, especially in the near term, I think the better we can all recognize.
Okay, what we saw there from Julie Beal is that she believes in companies that are driven and have an actual real physical world component, like clean water, right? Like, consumer staple companies. She talked about in a longer clip. I didn't include it to save your time, but she talked about consumer staples. Okay. So actual real physical goods are very important in this economy. And brands, as I mentioned, something like a Walmart or an Apple. These are phenomenal choices to have in your portfolio. And actually, I plan to add more unique stocks on this YouTube channel. I'm going to continue to do research because right now, diversification is a really important component to investing. I personally agree with Julie Beal, and we have to take a look at where opportunities are for cheap and discounted stock. You see, the stock market has pockets. It has some pockets that are extremely overvalued, it has pockets where there's no growth at all, and it also has pockets where there's good growth and the companies are misunderstood. We saw that for many years on Tesla. We saw that for a very long time on Palantir. The same for Nvidia. So I'm trying to be early and put you guys into positions where there's either alpha to be generated. Alpha is how much more money you can make beyond the stock market normal return. Okay, using options to hedge, using options to actually buy companies for much lower upfront capital and get huge upside. There's many strategies that you can employ right now, but the common theme that I want to tell you is you need diversification and you need multiple strategies in your portfolio right now to really weather the turbulence. Something that I also personally look at in this market update video is the health of jobs. Okay, I'm going to be sharing some data with you on mortgage rates and jobs, but the most important thing you need to know is this is a consumer-driven economy. Okay, you need to look at the strength of the consumer, and in my opinion, the consumer is a little bit weak right now. And that's a really bad thing for the stock market because that means that earnings right now are good. Think about it. Corporate earnings are really good. Like we've seen corporate earnings that were great from JP Morgan, from Walmart, yet Walmart had a really big pullback despite the CEO himself. I was watching an interview. I'm sorry, it was actually the prior CEO who has a ton of experience. He said that this was a amazing earnings quarter, yet the stock still fell down. So if the CEO, this is the craziest thing, if the ex-CEO was an investor himself, he would have made a mistake. He would have been wrong on the stock. So I bought shares prior to earnings. They reported good earnings and the stock went down. Does that make me wrong? I guess it does. The ex-CEO himself would have also been wrong though. So the market has a lot of confusion and the real way to win is to have that long-term mindset. Dollar cost average, all of the things I teach about on this channel, hedging with options, selling put contracts to get a stock for cheaper than it's trading at. it's a really good time to do those things, especially on some of the other stocks I'm going to be covering in this video later on. So from a market timing perspective, you have to be invested in the market because history shows that not being invested is a really huge mistake. But at the same time, we're at a very critical time. It seems like a lot of the stock market is peaking. We've had the best returns ever. If you've been an investor for longer than 6 months, you've skyrocketed your net worth, you've skyrocketed your wealth. And the economy is driven by the consumer and small businesses. And I think that they've done a good job, but the consumer is currently weak, which makes me more cautious. The housing market specifically, looking at January data right here, mortgage rates averaged 6.85%, contributing to a 4.9% decline in existing home sales from the previous month. Now, housing prices are very expensive, and this is bad because the housing market also drives a lot of the economy, and a lot of GDP comes from housing. A lot of people that are looking to get into the housing market are struggling, and those people are definitely not going to have, money to put into the stock market because, however, those people that can't really afford a house are looking for opportunities to be able to afford a house, and instead of buying a house, some of their money will be going to the stock market. So, I'm trying to give you both perspectives and the full picture of all the research that I've done. And the weird thing is, because the economy added 143,000 jobs in January 2025, with unemployment rate decreasing to 3.9%, we're actually looking like we have the best picture ever. But, the best picture ever is like a really healthy person. They may look very healthy, but maybe their blood work isn't super healthy. So although we have a very good economy that looks amazing, on the underneath side, taking a look at something like the CPI or the Consumer Price Index, it increased 3% from January 2024 to January 2025 with a slight rise in inflation. However, let me tell you, the government isn't really giving you an honest picture. The inflation is not 3%. The only reason it's 3% is because the government continues to manipulate the basket of goods within the CPI. Okay, so here's an example of how they manipulate this and what you need to understand to be a smarter and more informed investor in this market. The CPI basket is a basket of goods. Oftentimes, the government can switch up that basket for something called substitute goods. Okay, this is back to my economics degree. Substitute goods are something that is like one good for another. Imagine chicken and beef. Now you might be thinking to yourself, chicken and beef are not the same. And you are correct. In the CPI, they will put chicken and beef to be the same. But it's not the same. Like, I'd rather eat beef most of the time than chicken. They kind of manipulate the CPI basket, and essentially investors are getting robbed because some of this data is pretty false. And again, what surprised me the most was the Walmart stock reaction. Same store sales grew, guys, which is a really good insight because when same store sales grow, that means more people are shopping at the store. They had strong profit, and the former CEO said it's amazing quarter, yet the market pulled back anyway. So the long story short, before I move on to some other stuff here in my research, is that you just can't satisfy investors right now. It seems like the appetite for returns is getting more unrealistic, which is a significant concern for me, despite being super bullish on the AI revolution and still wanting to own a lot of tech companies. I'm looking to hedge them as much as possible with covered calls. And, I'll show you an example of that a little bit later on in this video. And I'll also leave some links in my description for free content that I have on covered calls. I think it's the smartest strategy that you should be implementing right now. And it's the only strategy I would be implementing right now with greater than, 50% of my portfolio, literally. And that's because you want to generate income right now. When you have uncertainty, options allow you to hedge your portfolio and create income regardless of the direction of the stock market. So, stocks can go up, they can go sideways, or they can go down. And a covered call strategy would bring you income in all three scenarios. So covered call strategy is very interesting. I'll get to that in just a moment. But I want to say that long-term investors should stay the course despite option trading, despite any other, beliefs, opinions, rumors. You should stay the course in the stock market. And I'm a big proponent of dollar cost averaging and holding on to stocks. So despite the title of this video, I still want you to be a long-term investor. And I am not personally a trader, okay? I don't believe in trading. I think people that make constant videos on, fear and panic in the market are fear-mongering for views so the YouTuber can benefit off of the views and the, products and courses that they sell. Now, I also have coaching. All YouTubers are selling something. Nobody's working for free in this life. But I want to tell you the honest to God truth that it's about long-term investing. You don't need to buy anything from me, certainly. I'm just telling you my philosophy and mindset and the best, tips I would have that I would give myself if I was, more of a beginner investor. I've been at this game for 11 years, so I'm trying to transfer as much knowledge for myself to you. Now let's talk more about the historical performance of the stock market to give you a good perspective. The stock market has consistently recovered from downturns with major indices like S&P 500 averaging 8 to 10% annual returns despite periodic decline. So we've had back-to-back 20% returns year to year. And if you think about it, guys, 20% year to year to year, now 3 years in a row, is very possible. And the reason I think this is happening is due to the AI revolution. AI revolution is increasing the productivity of workers. Productivity is one of the secret components that I haven't seen anyone talk about. And I watch all the option YouTubers as well. Like, I watch them just to understand who's copying me or who's making good content and what their perspective is, right? Because I want to understand everything. I want to understand every single aspect of stock market investing. And that's where I've gotten my edge. That's how I've scaled my portfolio to over $4 million. You guys transparently seen that. And something that I really haven't seen anyone talk about is, people talk about earnings, people talk about a stock's innovation, but no one talks about the general innovation and productivity, okay? From a macroeconomic perspective, okay, I have a degree in economics, and the formula is capital, labor, right? You have capital, you have money, and then labor. People, working and putting that money to work and producing goods and services, right? But nobody talks about productivity, okay? When you have AI improving the productivity of a knowledge worker, like a computer scientist or a software engineer, or even a doctor that no longer has to sit and take 20-minute notes after, talk to the patient. Doctors waste a lot of time. I work with a lot of doctors. They come in, they have a 10-minute conversation with a patient, and then they spend 20 minutes writing up notes. When you have AI that can improve how doctors take notes, when you have AI that can fix your code for you, when you have, AI that can increase the ability for lawyers, the list goes on. The applications are endless. This increases that person's time. And when you have high-end people that make a lot of money, you increase their time, then it exponentially means that they can make more money and produce more goods and services. So that's why we've had back-to-back years. And this is the most interesting, I would say, golden era to get rich. Like, I've gotten stupid rich off of the stock market. And that's essentially from, obviously, I know what I'm doing, but there's also a luck component. Like, I'm kind of lucky in the sense that it's a good time in the market. Like, everyone has basically gotten rich. It's just a factor of how rich have you gotten? Have you beaten other people? Because this game is actually a competitive game. The stock market has returns. Like, it's a proven game over like 100 years. It works. The only thing is, how much does it work for you? How do you outperform? And how do you get as much of that money for yourself as possible? I'm going to show you a quick example. I don't want to make this video too long. I want to show an example of a covered call option on Tesla. So Tesla is currently trading at $337 per share. My average cost is $218. I have significantly given back a lot of my gains on Tesla, but I'm still up $118,000 or so dollars, and it makes up 8% of this portfolio right here. You can see here that my options are up $14,000. This is my total overall option exposure to Tesla. So as Tesla has been pulling down, I have been able to save some money. I haven't been able to save all of my money, but a $14,000 hedge, that's how much I made in like roughly the past 30 days, is a really good return to protect yourself when a stock is falling. You can see here how Tesla fell $81, but of that $81, I've saved 14. I get it. Obviously, timing the market would have been better. If I could have seen what would happen early, then I would have saved $81. But I was able to save 14 of the $81. And I want to point out, despite the volatility, my portfolio has still returned over $100,000 in the past month, over 2.7%. And my portfolio was recently at a high only 5 days ago. So right now, I'm doing my best to hedge the portfolio and protect it as much as possible. And I think covered calls are going to be the best way for everyone to protect themselves. If you want a video on covered calls, you want to learn covered calls in greater detail, I'll put up a video on the screen right now. In the description, I'm also going to input a free course that I have on covered calls. And I plan to make more videos on covered calls. If you like this video, then, drop it a comment, a like, and a subscribe. And really, when you guys subscribe, then YouTube tells me to make more videos like this. So that's what helps me understand what content is helpful for you. With that being said, let's make some money. Let's continue to educate ourselves and let's continue to build our wealth.